The Oak Harvest investment team laid out our first half outlook in late 2022. Back then, the rhetoric was inflation was out of control, we were headed into a first half 2023 recession, and the S&P 500 would shortly retest its 2022 lows, call it 3,500. Strategist after strategist proclaimed the recession was imminent. We disagreed with this viewpoint, calling our outlook the old normal, economic cycles return. We published a first half 2023 target of 4,300 when the markets were trading around 3,800 at the end of 2022. Back then, our investment team got a lot of pushback on this outlook as negative headlines around inflation, the Federal Reserve, and headlines around the war on Ukraine and COVID lockdowns in China were rampant on CNBC, Bloomberg TV, and Fox News. Here's a weekly chart on the S&P 500 as of May 26th, going in the long Memorial Day weekend. So far, October 2022 has remained the market's low for the last 2 years. There's been no lower low. There's been no retest. The S&P 500 has made a series of higher weekly lows and higher weekly highs to rally back to 4210. Here's a monthly chart of the S&P 500. It's been a rocky road since December 2021, but we've held the uptrend intact since the first quarter 2009 great financial crisis lows, and the U.S. markets are trying to regain their upward momentum. Investors, would you be surprised if I told you that the S&P 500 is around where it was in June of 2021? 2 years ago, it's flat. Would you be surprised if I told you the S&P 500 is also sitting about where it was at the end of May of last year in 2022, or around 4,200? Spot on, flat for a year, and flat for 2 years. Interesting to note, the NASDAQ composite is basically flat for both the 1 and 2 year period as well, albeit with a little more volatility along the way. And guess what other index is flat for both the 1 and 2 year periods? Yes, the more value-biased Dow Jones Industrial Average has essentially churned sideways now for 2 years, albeit at a lower volatility than the tech-heavy NASDAQ. Hence, the title of this video being, It's Been a Long Road to Flat. It's a marathon, not a sprint. Before we get into this week's topic, click on both the subscribe button and the notification bell so you'll be alerted when we upload our latest Oak Harvest content. Or even better yet, give us a call at 877-896-0040 to set up an initial meeting with one of our retirement planning specialists. If you listen to those strategists' opinions on CNBC, or worse, those writing newsletters for $99 a year, you might have gone to cash in the summer or fall of 2022 when the markets were near their lows. If so, you're likely still sitting on the sidelines waiting to put your savings back into the markets at lower levels. Well, we have now regained about half the losses from 2022. As of this writing, opposite 2022, when the market was led by both energy stocks and safer, slower growth defensive names, 2023 has been led by higher growth technology and communication stocks recovering from their disastrous 2022 returns. Most of those names are heavyweights in the NASDAQ Composite Index. Here's a monthly chart of the NAS Composite. Many bearish commentators who missed the rally have made valid observations that much of the rally's move year to date has been helped by a few large cap names. This observation is true, although it's not unusual for this dynamic to happen during rallies or bull markets. Particularly frustrating year to date has been the wide dispersion in sector returns. Here's a table showing how dramatic the difference has been between the groups. As of May 26th, the best performing sectors year to date are technology and communication services, both sporting over 30% returns for the year. That's outperforming the S&P 500 by over 20 percentage points. Technology has tripled the S&P 500 year-to-date return of about 10%. The worst group, energy, was the best group in 2022. The energy group is collectively down over 8% year-to-date, trailing the overall market by over 20 percentage points. If you sold near the market lows in 2022 and went to cash, should you panic now? I don't think so. The summer season almost always gives investors a better chance to find attractive stocks at lower prices. Likewise, should you just give up on 2023 because the S&P 500 has rallied off its October lows and it's up over 10% year to date? The data says no. You shouldn't write off the rest of the year. In fact, according to data from LPL Financial, a strong first 100 trading days for the year has historically been a positive sign for the returns for the rest of the year. Viewers, there are no guarantees, of course, but here are the stats according to LPL. Through the first 100 trading days of 2023, on May 25th, the S&P 500 was up 8.1% in price appreciation. Since 1950, when the S&P 500 has been up 7% or more during the first 100 trading days of the year, the average gain for the rest of the year has been 9.4%. That's almost 2 times the average year from trading days 101 on. Here's all that data. Also interesting is the consistency of this data. After strong starts, the S&P 500 gained further in 24 out of 26 of the years, or 88% of the time. Only in 1987 did stocks experience a material decline after a strong start to the year. Recall in 1987, that included Black Monday in October. However, back then, stocks were up almost 40% year to date going into the October crash, and they still finished the year with an overall positive return. Investors, investing in public equities is a marathon, it's not a sprint. There are often periods when stock markets go nowhere net. They might move up or down. They might move lower, back to where they started quarters or even years earlier. This is the world of equity investing. There is no perfect investment philosophy. There is no perfect trading tool that's all weather, outperforming every stock cycle or every economic environment. At Oak Harvest, we have many tools that our advisors use to help our clients meet their retirement goals and objectives. These tools are both market-based and insurance-based, and that we can use both to meet your retirement goals. The future and the stock markets are always uncertain. That's why our retirement planning teams plan for your retirement needs first and your greed second. Give us a call here to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. For myself and the whole team here at Oak Harvest, have a blessed weekend.